Candlesticks in Forex trading are a visual way of showing price movements on a chart over a specific time period, like 1 minute, 1 hour, 1 day, etc. Each candlestick tells you 4 key things: where the price started open, where the price ended close, the highest price it reached, the lowest price it dropped to. Candlesticks are represented in 2 ways. Green candle or white equals price went up. Red candle or black equals price went down. Think of each candlestick like a story. Ask yourself, did buyers push the price up? Did sellers bring it down? Did price move a lot or just a little? Put many candles together, and you can start to read what the market is doing. Want to read the market like a pro? Let me show you 4 simple candlestick patterns every trader should know. Hammer and shooting star. A hammer at the bottom means price might go up, bullish rally. It signifies the end of a crash and a possible trend reversal. A shooting star at the top. Price might fall. This shows the end of a rally and a possible trend reversal. Bearish engulfing candlestick. Big red swallows small green. If this appears at the top of a rally, then the bears might push price down, as this could be a trend reversal. Bullish engulfing candlestick. A small red candle followed by a big green one. That's a bullish engulfing pattern. If this appears at the end of a sell trend, it probably means buyers are taking over. Doji. This is a doji. It looks like a cross and means the market is undecided. Watch out, it might reverse. Learn these and other relevant market analysis patterns I will share in subsequent videos. You'll stop guessing trades. Want more tips like this? Hit follow, like, and share.